What will the interest rates look like in 2024? Let's delve into this intriguing topic. The Federal Reserve, or the Fed, plays a significant role in setting interest rates. The rate they set, known as the Fed funds rate, influences the interest rates that financial institutions charge for lending. Banks and other institutions, by law, must keep a portion of customer deposits as reserves. When they need more liquidity, they borrow from each other at the Fed funds rate. Now, this rate has been increased 11 times since March 2022, hitting 5.5%. However, with inflation showing signs of slowing, the Fed has plans to reduce this rate 3 times in 2024, aiming for a 4.75% Fed funds rate. Understanding the Fed funds rate is crucial as it influences the interest rates on various financial products. Mortgage rates are closely tied to the 10-year Treasury yield, which is influenced by the Fed funds rate. This connection traces its roots back to the fundamental workings of our economy, where the cost of borrowing money is directly linked to the country's financial health. The Federal Reserve's decisions heavily impact these rates and, in turn, the housing market. Let's take a trip down memory lane to understand this relationship better. Around the turn of the millennium in 2001 and again in 2007, the Fed funds rate sat at 4.75%. During these periods, mortgage rates hovered around the 6% mark. This historical pattern provides a useful lens to view the potential future. Fast forward to 2024, with the Federal Reserve's current trajectory aiming for a 4.75% Fed funds rate, we can reasonably project mortgage rates to fall within the 5 to 6% range. This prediction marks a significant improvement from the present rate, which stands at a lofty 7.2%. However, let's temper our expectations. While this improvement is heartening, don't expect a drastic drop to the rock-bottom rates of 3% or lower. Such a significant decrease would require a much steeper drop in the Fed funds rate. In conclusion, the coming year promises a dip in mortgage rates, providing some relief to prospective homebuyers. While mortgage rates are expected to improve, they are unlikely to drop to the lows of 3% or below unless the Fed funds rate decreases significantly further. Credit card rates have historically remained high even when the Fed funds rate was low. Currently, we're seeing credit card interest rates at a record high of around 21%. But let's take a step back in time. There were instances when the Federal Reserve's rate was near zero, and yet credit card rates were above 14%. This pattern shows us that credit card interest rates don't always directly follow the behavior of the Fed funds rate. So what does this mean for 2024? Well, despite the anticipated rate cuts on the horizon, we might not see a dramatic drop in credit card rates. Based on the historical behavior and the expected changes in the Fed funds rate, credit card interest rates may only experience a slight decrease. We could be looking at rates settling around the 18 to 19% range. Even with the expected rate cuts in 2024, credit card rates might only slightly decrease to around 18 to 19%. Savings account rates also vary, with large banks typically offering lower interest rates compared to smaller banks. For instance, Ally Bank, a relatively smaller institution, currently offers a 4.35% interest rate on savings accounts. Now, that's quite a nice return on your savings, isn't it? But here's the catch. As we've discussed, the Federal Reserve is planning to decrease the Fed funds rate in 2024, and this will inevitably impact savings account interest rates. You see, when the Fed funds rate drops, so does the interest rate on savings accounts. It's a bit like a seesaw. When one side goes down, the other follows. So, what does this mean for your savings in 2024? Well, with the impending rate cuts by the Fed, we anticipate a decrease in savings account interest rates to about 3 to 4% by the second half of 2024, particularly in larger banks. So you might want to keep an eye on those rates and plan your savings strategy accordingly. For auto loans, there's a less direct correlation with the Fed funds rate. Normally, when the Federal Reserve adjusts its rates, auto loans are typically impacted, albeit not as directly as, say, mortgages or savings accounts. The reason being, auto loans are shorter-term loans and are less influenced by long-term economic forecasts. Presently, the average interest rate on a 5-year new car loan stands at a substantial 7.7%. Now, this might seem steep, especially when you compare it to the record low rates we saw during 2020. Back then, promotional 0% financing options were quite common, thanks to the historically low Fed funds rate. However, as we look forward to 2024, it's vital to understand that the expected drop in the Fed funds rate from 5.5% to 4.75% might not bring back those 0% financing options. Auto loan rates aren't solely determined by the Federal Reserve's decisions. They're also influenced by factors such as credit scores, loan terms, and the overall state of the car market. So while we can anticipate some relief as the federal funds rate goes down, predicting the actual impact on auto loan rates can be quite complex. It's not a straightforward calculation, but we can expect some reduction. While the federal funds rate drop might bring some relief, its actual impact on auto loan rates will be complex to predict, but expect some reduction. It's important to note that a fall in interest rates tends to increase demand for cars and homes. As we've discovered today, 2024 is set to bring some significant shifts in interest rates. From mortgage rates potentially dropping to the 5–6% range, credit card rates slightly decreasing to around 18–19%, to savings account interest rates falling to about 3–4%, and auto loan rates expected to see some reduction. These changes are guided by the Federal Reserve's decision to cut their funds rate from 5.5% to 4.75%. However, the influence of these rates is vast, affecting not just individual financial decisions but also the broader economy. Increased demand due to lower interest rates could inflate prices, bringing about its own set of challenges. As with all things economic, the landscape is complex and ever-changing. Stay tuned for more updates and in-depth analysis. Please subscribe for regular insights. Thank you for your support and engagement with our content.